Hey guys, Joe Franklin, market analyst for YouTrading, and in today's video we're going to be taking a quick look at a trade idea that I am currently monitoring. Now, it is to do with the S&P 500. As you can see here, I've got the chart up for, a CFD that tracks the price of the S&P 500 futures. And you can see that the S&P 500, it's seen a decent bounce today. It's up 1.5%. These are one-day candlesticks, by the way. But again, failing to get back to the north of this 200-day moving average, which is around 3,930, and struggling with resistance in the form of early March, late February lows. Now, obviously, there's been a lot going on in the last couple of days. We had the failure of those three crypto sort of tech-focused banks last week, which has caused a big shift in the macro regime, basically, because number one, it signifies uh, the potential start of a banking crisis in the US, or at least a very fragile situation in the US banking sector, which is going to need to be managed very, very well and very closely if it's going to be prevented from becoming a full-blown banking crisis. Now, right now, the response from authorities um, in the US, with the Treasury and the Fed and the FDIC all guaranteeing that all depositors of the three banks, or the two banks anyway, that depositors might have lost money on, they're all going to be made whole. So this is for now stopping like a really bad bank run. But there are still a lot of jitters about the weakness of the US banking system. So that's one thing. But then the other thing that we've had, let me just show you. We were talking about this in quite a lot of depth yesterday, but we had this big drop in US two-year yields, which have been all over the place, even went as low as 3.8% earlier today, which is just crazy, but now bounced about 50, nearly 60 basis points intraday to closer to 4.40%. 4.4%, sorry, but still way, way below the recent highs that we hit at the end of last week, above 5%, because markets have pretty much seen this massive paring back on Fed tightening bets. Instead of talking about 50 basis point rate hike this later this month, that's out of the discussion now. It's either nothing or a 25 basis point, and a couple of banks even talking about 25 basis point rate cut. Although let's get the CME Fed Watch tool up again. In wake of the latest US CPI figures, pretty much in line with expected. You know, decent headline drop from 6.4 to 6% as expected. Headline was at 0.4% month over month. So, okay, headline numbers, good, fine. Still trending in the right direction. Slightly hotter than expected core month of a month reading, though. So, net, still a little bit concerning, these inflation numbers, not easing as much as we would have hoped. And that data is interpreted as been supporting the case for a 25 basis point rate hike this month from the Fed. You can see yesterday, it's now currently money markets implying an 80% or near 80% chance of a 25 basis point rate hike later this month. Yesterday, that was lower at 65%. And then obviously 1 week ago, before the banking crisis all started, we were pricing a 70% chance of a 50 basis point rate hike. So that's how much things have reversed. And obviously it's not just about the cut, the upcoming meeting. It's also about the outlook for interest rates for the rest of the year. Markets about a week ago were thinking that interest rates could go into the 5.5 area or potentially even above. We're not talking about that now, really. Like let me pull up July, see where we're talking about interest rates. It looks like interest rates are not going to be above 5% at the start of the next half. Or at least that's the message that money markets are sending anyway. And then at the end of this year, money markets thinking that interest rates are going to be potentially back to current levels, which implies rate hikes later this year, or even below current levels. So we're currently at 4.5 to 4.75, even 4.25 to 4.5 or lower. So massive, massive shift in the macro regime. We're expecting a much, much easier Fed now. So let's get back to the S&P 500. Obviously, you've got the banking crisis, concerns about that and how it could impact economic growth, the outlook for earnings. That's capping stocks for now, below the 200-day moving average. But then again, this easier Fed outlook, should that be supporting stocks? Well, potentially, but not if. Imagine this. Given the banking crisis, investors actually don't want any more hikes. But it still looks like the Fed might press ahead with a few more hikes, maybe one or two. Well, at a time where you're trying to manage a potential banking crisis, that could be bad for equities. So, I mean, I'm not really sure where things are going to go here. I'm just going to be trading what I see. But if we continue to fail to get above this 200-day moving average, um, that's a bearish technical sign for me. And that could go in hand with fears about the banking crisis, fears that continued Fed tightening, even if that tightening is much more modest than what we were expecting a week ago, is still too much for the system to handle. Um, if we get this confirmation technically that we're not going to get back above the 200-day moving average, I think the door is still open for a retest of these lows here from last December. Actually, let's just draw some other important technical lines up here as well, because we have the trend from 2022, which we're currently grappling with as well. So, yeah, if we see another failure to get back above this trend line, back above the 200-day moving average, it all kind of feeds into the fact that I think we can retest these lows. And, you know, if the banking contagion worsens once again, um, which it could do next week. Imagine this: the Fed comes out with a 25 basis point rate hike and is more hawkish than expected and signals maybe another two or three 25 basis point rate hikes, much more than the market's expecting them to signal. That could rekindle all the kind of problems that we've just been seeing last week. Maybe a couple more regional banks shutting their doors and policymakers once again scrambling. And then the idea that the Fed doesn't have the situation under control and all of these kind of things. If this sort of worst case scenario was to play out, I mean, you could be talking about hitting these lows from last October. Obviously, if the Fed comes across more dovish, more in control of the situation with regard to the banks, and the financial stability and all that kind of stuff, which really should be their priority, even though inflation is still well above their target, at least it's heading in the right direction. Then obviously you wouldn't be talking about a drop like that. And you could actually be talking about a recovery back above the 200-day moving average. But yes, like I said, trade what you see here. This is a very fluid situation. But that's just one of the things I'm watching at the moment, guys. So I hope you all enjoyed this video. I hope you all found it informative, and I'll see you all in the next one.